So does today set the stage for more records as we look to close out 2025? Guy, nice to have a record close here in the final days.
You said ho-ho.
I did, yeah.
Well, it appears that, listen, so today we have we're half day tomorrow, right? Mm-hmm. We have a full day, I think, on Friday. Next week is the same type of week. It's hard-pressed unless some piece of news comes out where the market's just not going to continue to levitate. The old saying is don't short a dull market, and that's what we're seeing. So I think you're going to continue to see that. It's all asset classes. And quite frankly, it's a sell-off in the bond market as well, which also makes sense. We'll talk about GDP.
Yeah, Tim.
Well, nominal growth is probably north of 5% here. And there's an element on the inflation side that has to have you a little bit concerned, especially in a world where we have this kind of growth and we have an accommodative Fed. Equities should love this. And I think in the short run, the Fed is your friend. But I looked at 26, and I think it may not be as easy as it appears now with the Fed on this side and the view that the Fed's going to change and become a more dovish Fed. I think the dynamic here around corporate profit margins is also extraordinary. I think this is what we've seen over the last couple quarters, and I think we generally believe that the tailwinds are with us outside of trade tariff dynamics, which are certainly eating into some corporates, but others not so much. So I continue to be impressed by the fact that for all the negativity, or so it seems in terms of the headlines on the indices, that semis continue to outperform. Mm-hmm. I think they will make a new relative high to the market before the end of the year. And I think there are opportunities in some of those beaten up names. Broadcom's one where I just think a lot of that was overdone. But what's been impressive, again, I get back to banks, I get back to the cyclical part of the economy that should reflect the kind of numbers we had today that really have been extraordinary. Citibank, I mean, these are no longer value plays, actually. These are actually ones that are expensive.
Yeah, I mean, on top of semiconductors, industrials, financials, they are at or close to all-time highs at this point.
And Wall Street is trying to change the narrative. If you look at them, all the upgrades have been outside of tech. Or I should say 40 of the last 50 have been outside of tech. If you think that tech is going to lead again, it could lead again, but you need to see that coming back in. If Micron had a bad print, we wouldn't have the Christmas rally. Micron, I don't want to say it was the cause of it, but without it, we wouldn't have had it, if that makes sense. I do think you're going to see an easier Fed. I think the narrative changes once the year changes, and I think we can go higher in the overall market.
Yeah, it did seem that Micron enabled the bulls to see the bull case, right, to believe in it.
Yeah, I mean, I think the bull case is still there. I mean, I think when you're getting this GDP print, clearly the economy is running hot. I think that's what people are looking for in 2026. We're also looking at, we are likely going to see some high refund checks next year. We're expecting $50 to $55 billion that's injected into the economy after those refunds come in next year. And I think what was really interesting to see was how strong the consumer was. And that's what we saw with the GDP report. And I think something people don't give enough credit to is how much baby boomers affect the economy. They control like $84 trillion of net worth or something along those lines. They're a lot less affected by the labor market. So even though people are concerned that the labor market's soft, a lot of that is being controlled by older generations who aren't affected by that. And I think you're going to see a lot of this continue into 2026 and continue to see the economy do well.
How long, though, can the consumer feel bad? Fifth straight month of declines for consumer confidence and continue to spend. I mean, yes, you'll get a $2,000 check. Some households will, but that only lasts for so long.
Well, some of the things they're spending on, they have no choice. I mean, healthcare is a big component of this. I mean, I think we all would agree that, some things you have to do. And obviously, food costs and energy costs, although subsiding a little bit, I mean, they're still problematic. So they will continue to spend because they have no choice. The question is, should they be spending? And that's a conversation we have seemingly all the time.
I think we get back to this really difficult to analyze K-shaped economy and the different pieces of the consumer that we talk about and the different places where spending is actually really holding up. And I would point to airlines. I would point to certain parts of the travel experience. I would certainly, we've talked to kind of top line service businesses and they continue to do better. But it's a case where this has been very perplexing for the street, for the investor community to really say. I mean, it's not green light for the consumer, but it is a place where this kind of growth and those people that are employed are doing quite well here.
And 20% of the highest income earners are doing 50% of the spend. And sentiment indicators are what people say they feel. But you have to see where they actually spend the money.
Sure.
So I think people actually feel better with a job and they spend versus the sentiment.